Hi everyone, hope you're all doing well. Today we're going to talk about the state of the stock market. There's a big battle going away at the moment with people saying that we are going to head into a bit of a rough patch in 2023 for the stock market. And there's also a few other people that are saying that we're going to have a very good 2023 in the stock market. So today, let's look at what's going on and what's causing the bulls to say we're going to skyrocket and people saying that we are going to head to a bad end to 2023. So the big thing here is that we've had a good year. You know, look at the S&P 500 at the moment. We're up 8%. This is a very good year so far for the stock market, and it's not really a big surprise. The reason why it's not a big surprise that we're having a good year in the stock market is something that I called out a while ago. If you follow the YouTube channel, is that when you look at inflation, when inflation peaks, we normally do very well in the stock market. History tells us that when inflation peaks, and we were talking about this in 2022 for a while when the inflation peaked in June, I said from here we should do very well when we get to June in 2023, because I like looking at historic data. People talk about charts, technical analysts. I'm not bothered about that. I'm not bothered about where this squiggly line is going to tell you where this stock's going to go. I don't believe in a lot of that. Sometimes it may be useful, sometimes it might help you, but for a lot of time I don't believe in it. What I believe in is historic data. When we look at history, what tells us what happens from here? That's what I like looking at. And a year ago, we were looking at the data saying that when inflation peaks, which it peaked in June 2020, what is the S&P return a year after inflation peaks? And you can see here, the S&P posts 13% average total return a year after prices peak. And we look at what the S&P has done since a year ago. Let's go even further out on the stock market chart. Let's go to around about that June time when inflation peaked, when the inflation data came out that we peaked. And you look at the stock market, we're up about 11%. We're very, very close to history. And that's no surprise. That's why I like looking at history. And history, if you looked at history a year ago, we were about bang on with history. And that's why I like looking at history more over than any squiggly lines on a chart. So this isn't a surprise that this is why I was quite bullish for going into 2023 in the stock market, and that prices just got incredibly low. You know, one of the big fears that were there and what does history tell us when that big fear goes? We do very well. So I'm not surprised to see us do this well. You know, this is no shock to me. I've called it on the YouTube channel for a while. Now we've had a good rally. We're about a year ago since that historic data. What is next for us? Well, let's start with the bears. Let's go for the bears and then let's go for the bulls. So at the moment, if we take a little bit of a zoom out, the stock market's been a bit choppy. It's been stuck in a range. You can see here, basically for the last month, the stock market hasn't moved. Now, sometimes it is good for the stock market to take breathers, especially when you've been on a good run. That's very, very healthy. If you don't take breathers, look at 2021. We get to extended valuations, boom, we have the correction, and the correction is always far more aggressive. And it's the same when you look at the Dow. The Dow is basically the same. Now, the big disconnect at the moment is the Nasdaq. The Nasdaq in the last month is actually up nearly 4%. So why is the Nasdaq up so much and the S&P and Dow are basically flat? Why is there such a disconnect going on there? Well, the Nasdaq is heavily weighted to tech. And if you look at big tech at the moment, what's big tech been doing? Well, look at Nvidia. Nvidia, since 2022, absolutely crazy. You know, since the lows, it's up 142%. You look at the likes of Meta, this once dead stock that is going nowhere anymore. You know, it's finished. It's going to zero. I remember people posting when I was talking about Meta, it's going to $0. You know, it's $88, and since then, boom, you know, it's up 172%. You look at the likes of Microsoft. Microsoft, you know, this stock has gone from $222, and you know, this was a stock as well that didn't really have that much of a pullback. And you know, when you look at Meta now, it's basically it's not down. You know, through the bear market situation now, this stock isn't down anymore. It's nearly pushing all-time highs, and that's been on a crazy run as well. And you look at Alphabet. I mean, Alphabet as well. You know, through the whole AI situation, you know, it's going to get eaten up by ChatGPT, and even this stock has now started recovering. A lot of this is obviously a lot of people pointing to the AI hype at the moment and why prices are going absolutely crazy at the moment. But you know, really, if you haven't had big tech in your portfolio in the last couple of months, not as much. When we zoom out a bit further, you know, this time period, you know, a lot of things were rallying. But in the last few months, while the stock market's been flat, if you've not had big tech, you've probably underperformed the market. To outperform the market at the moment, you would have probably had to had big tech in your portfolio. Whether that be Nvidia, Meta, Microsoft, Google. For me, obviously, I've got 3 of them, so that has helped me do okay compared to the S&P 500. But obviously, I wouldn't say it's the majority of my portfolio, so I haven't done brilliantly, but I've done okay. But if you haven't, you've really underperformed the market. And the feeling at the moment now is that a lot of these, Nasdaq in particular, a lot of these big tech stocks, they've gone too stretched on the valuation. I mean, if you look at Nvidia, I mean, it's trading at 173 times earnings. 173 times earnings for Nvidia, and I think this year it's going to grow at 10%. I think next year they're forecasted for it to grow at 25% revenue growth. And you're looking here going, does a company like that should trade at 173 times earnings? And I think Nvidia is massively overvalued. I think, it's a good company, and it's going to have good growth, but 173 times earnings, I don't think so. And you look at the likes of Meta, for example, this is back at 30 times earnings. We would say it's pretty fairly valued at the moment. Microsoft, 34 times earnings. You'd say that's pretty fairly valued at the moment. You look at Google at the moment, it's 27 times earnings. It's getting to a lot more fairer valuation to Google. Not as much as the other ones, but a lot more fairer valuation. So you're staring at these sort of companies here and you're thinking, well, obviously, are these now a stretched valuation, and these stocks going to have a correction? And when these stocks have a correction because they've got ultra very rich valuations and they have 10-20% corrections, will that cause the likes of the S&P to come down 10%? Will that cause the likes of the Nasdaq to come down 10%? And that's what a lot of bears are saying. They're saying that we're really being propped up by AI hype. We're being propped up by these stocks in particular going to crazy valuations, and these need to have a correction now. And when that happens, it'll cause a big, massive correction. And I've got to say, I do agree. I do agree that we've gotten to very rich valuations in these couple of stocks. I don't think Nvidia should go to 173 times earnings. But the problem is am I going to be someone that bets against the likes of Nvidia? Am I going to be someone that bets against the likes of Meta? Am I going to be someone that bets against the likes of Microsoft? Am I going to be someone that bets against the likes of Google? No chance. I am not going to be betting against the likes of this powerhouse. This company that has a crazy track record of delivering financials, and even though it's rich valuations, I am not betting against Microsoft. Even though I think I think all these are rich valuations, even though I think like Nvidia is a rich valuation, am I going to bet against it? Am I going to plan that Nvidia, this beast of a company, is going to have a major crash or correction on the share price? No chance. Because these are quality businesses. A lot of these quality businesses, when they have dips, they will get bought up, and they will get bought up fast. And I'm not going to go against these sort of companies. So even though I think that a lot of them are crazy overvalued, I'm not going to change my long-term game plan because of these companies. I'm going to look at the bigger picture. I'm going to look at a lot of the smaller caps, mid caps. I'm looking at the growth stocks. I'm looking, what are they telling me right now? What is historic data telling me about these ones? Well, the next bit of historic data I've got for you guys is this. We are potentially heading towards a Federal Reserve final rate hike. A lot of people think we've had it. We'll see what happens. I think it should have been the last meeting. Some people are thinking it's going to be this meeting. But we're heading towards the final Federal Reserve rate hike. Now, I don't know if they've left, personally for me, I don't know if they've left it too long. I think this is maybe something that should have been done earlier, and the pause should have been done a lot earlier. I think that we have maybe caused a bit of damage in the economy. When you look at Home Depot's earnings, you can see that's starting to affect the economy now. This soft landing, is it still going to be a soft landing? We'll see what happens. But looking at the data here, what is the return following the final rate hike from the Federal Reserve? Well, if we have a look here, there's different points here. There's the average, medium, and the average since 84 as well. So let's just go, obviously, positive, positive, positive in the next 3 months. Let's go into the longer term. Let's look at where we're going to potentially be at the end of the year. Let's look at where we're going to be in 2024. If we look here, the average is 5.4%, and since 84, it's 12.1%. If we look at the 9 months, 5.7, 13.1. If we look at the 12 months for the average return of the S&P 500, 7%, 15.8%. So once again, I'm showing you some historic data here, and this event will happen in the coming few months. Now, the data once again tells us that this will mean the stock market will have a good return for the next 6-12 months. And generally for me, when you take into consideration, we talked about the big threat at the moment, inflation peaks. If inflation peaks, we're going to do well. If the Federal Reserve stop hiking up interest rates and potentially go cut interest rates, we're going to do well. I would not want to bet against the stock market in this situation. And then once again, when we follow that up by historic data tells us, once again, we're going to have a good rally. I think personally for me, I do think the S&P will finish off the year strong. I believe we will have a good 2024 in the stock market, and I don't want to be on the sidelines in case we miss another rally like this that we've had, you know, since June time. Any of you guys that missed that June time rally miss a good chunk of opportunities. If we go on another rally again, you talk about a 10% rally from the index on the S&P 500. You imagine once again what that's going to do for individual stocks. I do not want to be on the sidelines because I feel like, oh, you know, Nvidia's a little bit of a high valuation. What happens if that goes down? Oh, Meta's a bit of a high valuation. What happens if that goes down? Microsoft, what happens if that one goes down? What about Google if that goes down? I don't want to be planning my investment on all my portfolio because 4 stocks have gone a little bit high at the moment because of maybe an AI hype. We can agree that these stocks have gone up too much and they're very high valuations, but I do not want to plan my portfolio around that situation, because what happens is if I'm on the sidelines and we have, once again, history like the inflation peak, if history comes true once again and follows history and we go in the next 12 months on either a 7% rally or if we go on a 15% rally and I miss, if I'm on the sidelines because I'm playing day to day on that and I miss that rally, that is going to hurt my returns massively. That's going to have consequences for the next, not just the 12 months that I miss, but the averages that I could have had, the buying opportunities I could have had. That will punish my portfolio for many, many years if I'm on the sidelines. And I would be a lot better that if we do have a crash, I'd be a lot better to be in that situation and go through the crash than miss this rally. And that's why it pays to be long term. That pays why you don't time the market, because you want to be in for the rally. If you are in for the rally, that is where a lot of the majority of gains come from. Any of you guys that witnessed that through the June time, even though when you look at the S&P 500, even though the S&P 500 since that time frame, if we have a look here from these lows of like say June time, is up 13% from them lows. Just that time period there, a lot of you guys would have seen the difference that made. An example for that is HIMS. HIMS at that time frame in June was $3. Where is it now? $12. That was where the market rallied up 13%. You had a stock like that 4x in that time frame. Gambling on the short term, being on the sidelines, trying to play on short-term rallies, short-term dips. As long as you're in for the long game, that's when you get the rewards like that. And I need to be playing the long-term rewards rather than short-term rewards anyway. So that's my thoughts on the potential of a bear market crash or a correction and the extreme valuations some big techs at, and also history. Why I also want to be on the bullish side and why I'm following history and I'm not gambling or using these big techs as a short-term play of, oh, I need to be a bit cautious here, because I can't afford to do it. I can't afford to do it, because if I miss a rally, it's going to punish me, and that's why I'm still buying, I'm still holding, and when I look at history, I'm actually still bullish on the market, even though some big techs are very rich valuations and maybe lifted up by the AI hype at the moment. Hope you enjoyed the video as always, guys. If you could hit the like button if you're not here, subscribe, and I'll see you all in a bit.